Yay, I'm back. Many apologies. What a complete balls up on a Friday afternoon. It's been a long week. I do apologise. Right, let's start this again. Divergence, a tool that I use a little bit, not a great deal. I use it in conjunctions with other patterns, which we'll get onto in a minute. So divergence, what is it? What indicators do I use when I'm trying to spot divergence? The different degrees of divergence. There's bearish or bullish divergence class A, B, and C, and we'll discuss all three of those. How do I trade divergence, and where am I likely to see divergence? Now, those two last titles at the bottom are probably the most important. So what is divergence? Bearish divergence, the chart makes a higher high while the oscillator, and again we're going to talk about different indicators, makes a lower high, is often a signal of exhausted bullish momentum, in this case because we're looking at bearish divergence, or we should see at least a correction lower. Sometimes there are reversal patterns or reversal tools. Sometimes they just highlight corrective moves to the downside. This is why it's quite important that we combine them to other analytical tools, which we're going to talk about in a bit. Bullish divergence, chart makes a lower low while the oscillator makes a higher low. And again, often a signal of exhausted bearish momentum, or at least a correction higher. Again, like most technical tools, it's not something that should be used standalone, and also like a lot of technical analysis, it's a lot easier to spot where we've seen bullish or bearish divergence after the event. So what we're going to talk about in this brief webinar today on a Friday afternoon in some mad markets is what other tools I should use with bullish or bearish divergence. What indicators can I use? Indicators, oscillators. The four that I've put down here are probably the most popular oscillators. Oscillators are momentum indicators. They highlight supply and demand. When momentum starts to drop, we get bullish or bearish divergence. So the four oscillators: RSI, relative strength index, momentum, it's a momentum indicator, stochastics, and MACD, moving average conversion divergence, obviously convergence, divergence, it's all in the name. If we go to the next slide, convergence generally means coming together. Divergence generally means moving apart. So if we're coming together or we're in sync, then we're converging. If we've got divergence, it basically means that we're going in opposite directions, and either that's wrong or that's wrong, basically. So the first example, we're just highlighting some bearish divergence. This was from a euro-dollar 30-minute chart today. So we can clearly see here that price continued to move to the upside, but the oscillators, and the two that we're going to use for this webinar, the MACD and the RSI, both moved to the downside. Note here that the RSI on this first peak, okay, was overbought, and on the second peak wasn't overbought, but was still moving to the upside. So clearly noting divergence there. And also on the MACD, we have a MACD crossover, and which is a signal in its own to sell, and the lines basically continue to move in the correct direction. In other words, they haven't moved again to the upside. What does divergence tell us? Now, divergence tells us that the upward or downward movement is losing momentum. So, like we said before, if we go back to this chart here, the chart continues to make higher highs and higher lows, but the strength of those moves, and in this case to the upside, is losing strength, and we're starting to lose momentum, basically. So there's 3 different types of divergence. We've got divergence A, divergence B, and divergence C. A being the strongest. For all of these examples, I'm using bearish divergence. So bearish class A divergence happens when the market makes a higher high and the oscillator makes a lower high. So we've already discussed that. This often signals a sharp drop in price action for the product, currency, index, etc., moving, and it will often move towards the previous area of support. So just going back to here, this was the previous area of support, and we actually surpassed that this morning. Class B divergence is not as strong. Class B divergence will often be noted as a double top or a treble top. So the chart makes the same high, but the oscillator makes a lower high. And then we've got Class C divergence. Now, Class C divergence is hard to find, and in fact, it probably took me about an hour this morning hunting back through loads of different currency pairs, trying to find Class C divergence. Class C divergence is also known as hidden divergence, happens when the chart makes a higher high, but the oscillator only makes the same high. It does have the same effect. So Class A, like we said, we've noted that one earlier. We've got higher highs and lower highs on the oscillators. Class B, so this was a treble top, could be seen as a head and shoulders, I suppose, with this middle peak just surpassing the 2 previous highs on either side. But both of the oscillators again move to the downside. Okay, so a lot of times as well with the RSI, you will actually be able to put a trend line on it, especially if you're looking at a wedge. And what the wedge formation is one of my favorite formations to trade divergence. So what happens with a wedge formation, we're going higher, but it's clear that the move to the upside is getting smaller and smaller and smaller and smaller. And that's why it's like a coiled spring, the wedge formation. When it breaks to the downside, it's normally very aggressive with the target level being the start of the wedge formation. And what you can normally do with an RSI indicator when on that wedge formation, so you've got the trend line on for the bottom of the wedge moving higher, and what you will be able to do is on the RSI, you'll be able to put a trend line virtually on the peaks of the RSI as it's moving lower. And that is probably my favored way of trading divergence. But anyway, digressing a little bit, Class B divergence is the same high, either treble top, double top, with the oscillators moving to the downside. Class C divergence, like I said, pretty hard to find. We've got the chart making the same highs, but the oscillator making a higher high. Note that it's only the MACD that's making the higher high, and in fact the RSI is still making a lower high. Where were you likely to see the different cases of divergence? Now, we already said a double or treble top or double or treble bottom. The ending wedge formation, which I previously said is probably the favored tool for trading divergence. The 5th wave of an Elliott wave formation. Now, think about if I don't know if you're into Elliott wave, but we've got wave 1, wave 2, up in 3, and then normally quite a choppy, potentially a flag formation before we move higher in 5. Now, Elliott wave enthusiasts know that the 5th wave is basically where the smart money are starting to get out of the sequence and potentially even reverse their positions, and it's where the silly money or the late money, I should say, is still building or even starting their long positions, but they've missed the rally. And you'll notice on 5th waves that it's very choppy indeed, because we're getting buying and selling, and normally in a 5th wave we'll also see that ending wedge formation. So it's a prime example of divergence. And then at the bottom there I've put a head and shoulders. The head and shoulders a lot of the time is seen as a treble top. What will normally happen is that you'll get the bearish divergence, and I'm talking about obviously a bearish head and shoulders. You'll get it on the first two legs. So obviously the middle leg being higher, and that's where we'll see our divergence. How do I trade divergence? Well, like I was saying previously, like most technical tools or indicators, they're very easy to spot after the event, but they're quite hard to trade actually during the event. So you really want different technical tools or trend lines, etc., to confirm your divergence. So I put here a break of trend line support or resistance, and again thinking about the wedge formation, you've only got confirmation of the wedge when it breaks to the downside. If it doesn't break the trend line support, then it can continue to move higher. Reversal formations, bearish engulfing candles or bullish engulfing candles, morning doji star, evening doji star, etc. You might even risk going in a little bit earlier if you've got some other indicators that are highlighting that you've got strong resistance to the upside. And I keep on going on about bearish divergence because I'm just going to use that one scenario through this webinar. So you might have like a solid Ishimoku daily cloud, and you stalled and you formed a doji. So maybe you don't want to wait for a break, like a break of trendline support. Maybe you think that's enough with that divergence to get short of that index currency pair, commodity, etc. Or the MACD confirmation. So as we said earlier, sometimes when you get divergence and it's only two swing highs, in other words, you're not forming a wedge necessarily, but it's just two swing highs. When you get that second swing high, if you've got the MACD crossover, which is the lines crossing over themselves, then that as well can be a good indication of confirmation of divergence. And also, if you were to use that scenario, then I would also look at a confirmation from the RSI as well. It's always a little bit stronger if you can use two oscillators as opposed to just the one standing on its own. Okay, guys, sorry for the mistakes earlier. I hope you enjoyed that. I hope you have a great weekend, and we'll be back again next week with some more webinars. Many thanks.